Welcome to Balance of Economy. Before we dive into the data, please note that this is market research for educational informational purposes only and does not constitute financial advice or recommendation to buy or sell any asset. Let's look at the numbers.
Absolutely.
So, I want to welcome you to today's deep dive. We've got a really fascinating one for you today.
Yeah, we're looking at some wild numbers.
We really are. Our sources today are recent financial disclosure texts and live portfolio tracking charts, and they outline the early 2026 portfolio of Nancy and Paul Pelosi.
Right, which the financial sector affectionately calls the Pelosi Index.
Exactly, the Pelosi Index. Now, our mission today is to decode exactly why this specific portfolio is just, well, it's consistently beating the market.
And just to be crystal clear right up front, we are looking at this strictly impartially.
Yes.
We are taking zero political sides here. We're just looking at the alpha being generated and the tactical execution of the trades, stripping away the names entirely.
Right, completely objective. So let's just set the baseline. In 2025, the S&P 500 had a remarkably strong year. I mean, it returned 20.3%.
Which is huge.
Yeah. For most institutional investors, hitting that benchmark is like a career-making achievement.
Oh, for sure. You hit 20%, you're a hero.
But over that exact same window from January 2025 to January 2026, this specific portfolio just shattered those numbers.
It completely shattered them.
They pulled in a 41.7% return.
Yeah, 41.7. And, when you look at the raw performance data in these tracking charts, you realize the momentum is structural.
What do you mean by structural?
Well, I mean, it's not just an anomaly, right? It's not tied to a single, lucky fiscal quarter.
Yeah.
If you look at the 250-day chart leading up to April 13th, 2026, the portfolio is sitting at a 32.88% return.
Wow.
Yeah. And if we widen the lens, if we look at a 5-year horizon, this specific paper portfolio boasts an 88.80% return.
88% over 5 years.
Exactly. Comfortably outpacing the S&P 500's 66.27%. You can actually see on the charts the blue tracking line of this portfolio aggressively separates from the gray benchmark line of the broader market.
And it maintains that gap year over year.
Right. Exactly. Maintains the delta.
But, if you look at the pie chart of the actual holdings, it doesn't initially look like some highly secretive proprietary strategy.
Oh, not at all.
I mean, it reads like a standard Silicon Valley index fund. Alphabet is sitting at the absolute top, commanding 20.10% of the entire portfolio.
Which is a massive allocation.
Huge. And Apple is right behind it at 16.30%, then Nvidia at 15%.
Right.
And then you have Microsoft taking up 11.3%, Amazon at 10.5%, and Salesforce carrying 6.4%.
These are basically the most scrutinized companies on Earth.
Right. They are heavily traded, massive companies. I mean, Alphabet and Apple are hovering near $3.8 and $3.9 trillion market caps.
Trillion, yeah.
So the obvious pushback I have to ask is this outperformance just a matter of getting lucky by parking cash in big tech?
Yeah.
Or is there a specific, mechanical engine driving these outsized returns?
Yeah, that's the core question, right? Because if they are buying the exact same mega cap tech monopolies that, every retirement fund in the country holds, why are their returns double the market average?
Right. Why?
Well, the alpha isn't actually found in the tickers they were selecting. It's found in the capital efficiency of how they acquire them.
Okay, unpack that a bit.
So they were not simply logging into a standard brokerage and buying equity shares at the spot price.
Yeah.
The mechanical engine driving these returns is a really concentrated, aggressive use of LEPS.
EPS.
Right. Long-term equity anticipation securities.
Let's break down the math on those LEPS for a second, because I think this is where a lot of retail investors kind of misunderstand risk.
Absolutely, they do.
Options trading is usually synonymous with high-risk speculation, right? Trying to guess what a stock will do by next Friday.
Yes. The Wall Street bets kind of approach.
Exactly.
Yeah.
But LEPS operate on a completely different time horizon.
They do. See, standard options contracts are really sensitive to time decay.
Theta.
Right, theta. Every day that passes, your contract loses value because the window for the stock to make a favorable move is literally closing.
Makes sense.
But LEPS sidestep that primary risk. They push the expiration date out 1, 2, or even 3 years.
Oh, wow. So you have a ton of breathing room.
Exactly.
Oh.
You buy a call option, which gives you the right to buy 100 shares of the underlying stock at a specific strike price. But you have years for your macro thesis to actually play out.
So it's almost like, okay, think of it like putting down a non-refundable deposit to lock in today's price on a luxury house,
Yeah,
a house you officially intend to buy next year.
that's a great analogy.
Right, so even if that neighborhood's value skyrockets in the meantime, you've already locked in your entry ticket.
It's giving you massive upside of the real estate appreciation, but you only had to put down a fraction of the upfront cash compared to, buying the whole house outright today.
That is exactly it. That capital efficiency is the absolute cornerstone of this strategy. Let's look at the specific 2026 disclosures from our sources.
Okay, what do they show?
They executed 50 call options for Alphabet. And the estimated value on that is between $500,000 and $1 million.
Well,
And then they mirrored that exact same move with Amazon, another 50 call options in that $500,000 to $1 million range.
so they're putting down some serious deposits, to use the analogy.
Right. And by buying deep in the money, Leap PS, they secure a really high delta, which basically means the options price moves almost 1-to-1 with the actual stock price.
Oh, I see.
So they effectively control thousands of shares of Alphabet and Amazon, capturing all of the upward price momentum, but they deploy drastically less capital.
Because the leverage acts as like an asymmetric amplifier.
If Alphabet goes up 10% over the year, the S&P 500 investor holding regular shares gets a 10% return.
Right.
But the investor holding the Leap PS might see a 40 or 50% return on their invested capital just because of the math of the contract.
Yeah. But we have to remember, leverage is inherently volatile.
Always.
If the underlying asset drops significantly, an options contract can expire worthless, meaning a total loss of that specific capital.
Ouch. Yeah.
Right. And this is why you only see this portfolio deploying the AMES strategy on companies deemed too big to fail.
Ah, okay. The structural monopolies.
Exactly. Over a multi-year horizon, the probability of Amazon or Microsoft experiencing a total unrecoverable collapse is, well, it's statistically minute.
They're hedging the mechanical risk of options against the massive balance sheets of trillion-dollar tech giants.
You hit the nail on the head.
So that actually brings us to where that massive leverage is currently being aimed in the early 2026 data, because the portfolio is undergoing a pretty severe rotation right now.
Very severe. The sources explicitly characterize it as an all-in bet on artificial intelligence infrastructure.
All in.
Yeah. And you can see how they're funding this aggressive pivot by looking at what they're actually liquidating.
Right. Let's look at the late 2025 and early 2026 sell-offs. They provide a really clear macroeconomic thesis.
What did they dump?
Well, they heavily trimmed their Apple position. They
Right.
completely exited PayPal.
Completely.
Completely. And they drastically slashed their Disney holdings, which now sit at a mere 1.40% of the portfolio.
Wow. That's a huge shift.
It is. I mean, think about it. Disney and PayPal are highly sensitive barometers for consumer discretionary spending.
Oh, for sure.
When everyday household budgets tighten, theme park vacations and online retail transactions are the very first things to get cut.
Yep. The nice-to-haves.
Exactly. By dumping those assets, they're essentially projecting a weak consumer economy and simultaneously betting that corporate B2B spending is going to explode. They are selling off the established consumer tech to buy the pickaxes and coal needed to run the new AI industrial revolution.
The pickaxes and coal. I love that. And that infrastructure is almost exclusively tied to AI compute.
Right.
Look at the January 2026 execution on Nvidia. They actually exercised call options to take delivery of thousands of Nvidia shares at strike prices that were fixed all the way back in 2025.
Oh, wow. So they locked in that old price.
Right. They held the long-term contracts, rode the massive wave of Nvidia's appreciation over the last year, and then chose to actually acquire the shares at a steep discount to the 2026 market price.
Cementing a permanent bullish position.
Exactly.
But the AI thesis goes a lot deeper than just buying Nvidia chips, doesn't it?
It does. The disclosures highlight a massive accumulation of Broadcom.
Ticker symbol AVGO.
Yes, AVGO,
Yeah.
which now makes up 6.20% of their total portfolio. And Broadcom isn't the flashy consumer-facing AI like ChatGPT.
No, it's the plumbing.
It is the critical networking layer.
Yeah.
I mean, you can buy 100,000 highly advanced NVIDIA GPUs, but if you cannot string them together into a unified computing cluster,
They're completely useless.
exactly. Broadcom designs the custom silicon and the high-speed Ethernet switches that act as the nervous system for these hyperscale data centers.
So they're capturing the capital expenditure of every major tech company trying to build an AI cluster.
Right. We also see a very strategic, albeit a bit smaller, entry into Tempus AI, ticker TEM.
Them.
Yeah, this is a highly speculative entry. It represents a pivot from the hardware layer into applied precision medicine.
Oh, interesting.
Yeah, Tempus uses AI to aggregate and analyze clinical and molecular data to personalize disease treatment.
Wow. Okay, so this shows a really layered timeline. They hold the AAPS on the megacaps, building the models. They hold the equity in Broadcom, providing the networking infrastructure. And they are seeding speculative capital into applied AI use cases like Tempus.
It's a full stack approach.
It is. But if you look closely at the filings, there's a massive physical bottleneck threatening all of this digital growth.
Yes.
And the portfolio has actively hedged against it.
You're talking about the transition from compute-constrained AI to power-constrained AI.
Exactly.
Because training next-generation large language models requires gigawatts of electricity. And the physical electrical grid in the United States is simply not equipped to handle the sudden, massive draw of these new data center hubs.
It's a huge problem.
Which brings us to probably the most revealing transaction in the recent filings, the Vistra play.
Ah, yes. Tick symbol VST. So the January filings show $100,000 to $250,000 options position in Vistra.
Right.
And for those who don't know, Vistra is a legacy energy production and retail power company.
Based in Dallas.
Right. So in a portfolio completely dominated by Silicon Valley tech giants, a Dallas-based power company sticks out like a sore thumb.
It really does. But it is a vital supply chain hedge.
Yeah.
Like you said earlier, they are not just buying the gold miners, they are securing the water rights to the only river in town.
The only river.
Yeah. Hyperscalers like Microsoft and Amazon have these really aggressive carbon neutral goals, right? Which means they historically favored winds and solar.
Sure.
But renewable energy is intermittent. You cannot run a billion-dollar AI data center that requires 24/7 uptime on a power source that fluctuates with the weather.
No, you need baseload power.
Exactly.
You need nuclear and natural gas, which is exactly what Vistra provides.
Right. By taking a leveraged options position in a legacy energy producer, the portfolio is betting on immense pricing power.
Because as the tech monopolies become increasingly desperate to secure, dedicated uninterrupted power for their AI clusters, utility companies with existing baseload infrastructure will just be able to dictate unprecedented terms.
Exactly. It is an acknowledgement that the digital AI revolution is fundamentally tethered to the physical limitations of the power grid.
Wow. That's fascinating. But okay, let's pivot slightly. Because if the portfolio is so heavily leveraged on high-growth AI and tech infrastructure, that inherently creates massive beta, right? Or volatility risk.
Volatility risk.
The entire strategy is balanced on the nice edge of the tech sector's continued dominance. So how do you hedge a beta that high?
You anchor it.
You anchor it. And looking at the January 16, 2026 filings, that anchor appears to be traditional financial services.
It does. The filing details a direct purchase of 25,000 shares of AllianceBernstein, ticker symbol AB.
AB.
Yeah. This is a global asset management and research firm. The estimated value of the transaction is between $1 million and $5 million, and it currently sits at about 0.80% of the total portfolio.
Okay, so moving capital away from the high-octane growth of tech and into a steady, yield-generating asset manager like AllianceBernstein, that signals a very specific macroeconomic stance.
It really does. Because asset managers benefit structurally when global capital markets are healthy and when interest rate environments stabilize.
Right, which encourages institutional investment flows.
Exactly. It acts as a counterbalance. If the tech sector experiences a severe multiple compression, having a robust financial services position helps absorb the shock.
But, the strategic rationale behind this AllianceBernstein trade, it's almost eclipsed by the structural reality of how the broader market reacts to the trade itself.
Oh, this is the really wild part.
Right. I mean, we only know about these 25,000 shares or the Vistra options or the Tempus AI entry because of the Stock Act.
The Stop Trading on Congressional Knowledge Act.
Yes, the Stock Act. This legislation mandates that financial disclosures by specific political figures and their spouses must be publicly filed within 45 days of execution.
45 days. And in modern finance, 45 days is an eternity.
Seriously, the market prices and global geopolitical events in a matter of milliseconds. Yet, despite this massive lag in information, these delayed disclosures have spawned an entire, highly lucrative cottage industry of financial tracking.
They have. The information asymmetry here has created this bizarre market microstructure. You've got platforms like Unusual Whales and Quiver Quantitative,
Right.
and they have built these really sophisticated algorithmic businesses purely around scraping these government databases.
Meticulously tracking every filing.
Yeah, they don't just, like, send out a weekly newsletter. Their systems are designed to detect a new filing the millisecond it hits the server and instantly broadcast that data to millions of retail traders.
And automated trading algorithms.
Exactly.
So market watchers essentially treat these 45-day delayed filings as the ultimate leading indicators, or signals.
They treat them as gospel.
But if a listener tracks these disclosures, are they looking at genuine predictive genius, or are they just witnessing the sheer momentum that happens when massive capital advantages meet legislative visibility?
That is the ultimate question. The quantitative reality of this ecosystem really forces us to question the nature of the alpha we discussed earlier.
Okay, trace the mechanics for me.
All right, let's trace a disclosure. Say the portfolio executes a trade on January 1st to buy a specific semiconductor stock.
Okay.
Because of the Stock Act, they have until mid-February to disclose it. During that 45-day window, the asset trades normally. But the exact moment that filing is published in February, the algorithmic scrapers instantly push buy orders.
Oh, wow.
Right. By the time a human retail investor gets the push notification on their phone and tries to copy the trade, the asset price has likely already gapped up.
Because the institutional algos front-run the retail wave.
Exactly the sequence. Millions of retail dollars flood into the asset, desperately trying to mirror the portfolio strategy. But this massive influx of buy-side pressure fundamentally alters the market.
It changes the asset itself.
Yes, the sheer volume of the retail swarm pushing into the stock artificially inflates its price.
Which creates an incredible feedback loop. The retail investors copying the trade end up pumping the value of the very asset the original portfolio purchased 45 days prior at a much lower cost basis.
It completely blurs the line between predictive genius and market-moving momentum. When a portfolio becomes this heavily scrutinized, the act of simply disclosing a position becomes a catalyst for appreciation.
So the tracker platforms, the retail forums, the automated algorithms, they all act as a collective mechanism that validates and financially reinforces the original trade.
They do. It's a self-fulfilling prophecy.
Which brings up a fascinating structural paradox to eyes on. We know the portfolio leverages AAPS for massive capital efficiency.
Right.
We know they're aggressively rotating out of consumer discretionary and building an ironclad fortress in AI infrastructure and baseload energy.
Yep.
But the ultimate variable might be the audience itself.
Exactly. Think about this for a second. If millions of market participants are utilizing tracking apps to blindly copy the Pelosi index on a 45-day delay, does the broader market's efficiency quickly absorb and eliminate the alpha, leaving retail traders holding the bag on overvalued assets?
Huh.
Or, and this is the really provocative thought, does the relentless algorithmic swarm of retail copycats actually serve to artificially inflate the value of the portfolio's holdings, supercharging the strategy and making it vastly more profitable than it ever could have been in a vacuum?
That's the data for today. Now, I want to hear from you. Is the Pelosi outperformance a result of superior strategy, or is it a signal that the game is rigged? Drop your thoughts in the comments below. Don't forget to subscribe to Balance of Economy for high-density market insights. Stay sharp and stay informed.